Today we're going to be talking about push versus pull and the future of data collection for regulatory reporting. We've recently published a white paper on the topic, where we interviewed many people from industry and from regulators on the sort of approach to data collection and how the future might look like. As many of you may know, there is a Bank of England project that Andrew is that works on that is on the future of data collection, and so it's a very hot topic for many people. It's very interesting because it's not necessarily a right or wrong answer, and so yeah, we hope you enjoyed the discussion. Our panelists today are all kindly donating their time to us and their experience and their points of view. I'll stress that these are their personal points of view and not the points of view of their firms. And so we look forward to their input and the discussion today. And so I'll introduce them briefly. I know we're running behind a few minutes, and so we can get started quickly. So Carl McKay is the head of Firmwide regulatory reporting and analysis for JP Chase. He's responsible for the production and filing of the financial, capital, and capital stress test reports for the firm to the various US regulators. Jody Gerbes is the America head of finance, risk and finance data at Deutsche Bank. Jody is responsible for the risk and finance data governance, data quality, data management, as well as the implementation and execution of the bank's BCBS 239 compliance framework in the region. Andrew Turvey is the director of Prudential risk at Belmont. He's recently been elected chair of the Bank of England's Reporting Transformation Committee, which is part of the regulator's joint program working with reporting firms to transform data collection. And so thank you very much to our panelists. And so I guess as a brief introduction, we want to see just what percentage of the audience, I guess how much you're aware of the push versus pull dynamic. So we're going to launch a poll now. And so just a quick one, it's not completely anonymous, but if you can give us your sort of opinion from what you know at the moment, if you think pushing or pulling is better for regulatory reporting. And it's okay to not know yet. It's kind of the reason we've written the white paper and organizing this webinar. So you should see it on the screen, and you can click one of the choices there. One voted? Yeah, okay. Good percentage. So let's share the results there. And so this is really great, I think, because it's a real mix. And so, usually these polls, they can go either way. If everyone chooses the same thing, it might not be a lively discussion. But so I guess to start off, maybe I'll just ask the panelists, what do you think of these results? Carl, start with you. Do you think it's is that the general, I guess, feedback in the market? You think that people are just a little confused by the
first of all, thanks very much for putting this together. I mean, it's a pretty interesting topic for all of us to get involved in. The fact that you've almost got a third across kind of the answers is pretty indicative of this is a very new area and something that I guess a lot of people haven't really thought about. So there's not really a polarized yes or no. I think, and we'll go through some of the discussion today is really about there's definitely pros and cons to both options. And I think hopefully by the end of the discussion, people will maybe end up in a yes to pull or no to pull. But yeah, I definitely think it's a fair indication of it's a new topic, and the fact that people are not really, we actively as sort of professionals in the industry have probably not had to think too much about it because we've been very much in the traditional push model.
And I guess it's for those of you that are in the don't know camp, we are very much in a sort of push mindset. And so from just to, I guess, clarify the terms, and we do this in the white paper, is pushing is very much the approach that we're in now, where we regularly push data to the regulators at the end of the month, end of the week, end of the quarter, end of the year, And so there's a constant sort of one-way communication, whereas pull would be sort of the opposite approach, where you prepare data, make it ready, and the regulators would come to pull that data either on a regular basis or maybe on an ad hoc basis, still to be decided. But it's a different, I guess, conceptually way of thinking. And Andrew, you're working, I guess, or leading this committee at the Bank of England. How do you guys, position this? And I'm sure you've been talking to many firms and many people, doing roundtables as well. What is the sort of, I guess, the feeling that you get from the market when this topic comes up?
I think it's a very interesting set of results. It's what I would expect, but actually I think it's very encouraging as well. Particularly the don't knows, because actually people seem to be quite open to say, actually, you know what, we don't really know whether this is, we don't know the full pros and cons of this, but we're not ruling it out. We're not violently opposed to it. We're very much open to looking at it. And this is very much where the regulators here in the UK are coming from it as well. The whole idea behind this program that we're working on transforming data collection. This is about recognizing the fact that actually a lot of what we do in terms of regulatory reporting in the UK and of course around the world is based on reasonably old technology. So this is technology which in some cases has been in place for decades. And in some cases, actually, believe it or not, some of these returns that we're doing today actually have precedence in handwritten returns. It's that old in terms of the technology that we're talking about. So the whole reason why TDC was set up is that there's a recognition there's a lot of new ways of doing things, including this push versus pull, but a whole load of other technologies as well, which are available now. A lot of opportunities to rethink regulatory reporting, redesign it, and look about doing it in a different way, a way that is more efficient for firms. UK alone, we spend billions of pounds a year to produce regulatory reporting. So certainly, yes, there's a lot of opportunities to be more efficient and more cost effective for firms, but also more consistent as well. Right now, for many firms, regulatory reporting exists in a very separate silo to internal MI reporting, risk management. So bringing those together and making those closer together, I think, is also a big benefit for firms. And on the regulatory side, there's a lot of drivers there as well. They're very interested in the richer data that they can get, the more timely data, the more flexible data that they're able to produce, and of course, very, very focused across the world, not just in the UK, but across the world, very focused on data quality as well, and how they can improve that. So all of these new technologies very much point that way, and great initiative from Suade to look at this particular issue. Great to hear these kind of discussions going on, and I think the regulators are very open to looking at all sorts of different models.
Yeah,
Jody.
Yeah, I say, when I saw the options, right, I think there were, I was kind of hoping there was going to be all of the above, right? Because I do kind of feel like when you start to consider what would be involved in migrating to a different model for how data is delivered to the regulators, just the kind of what the drivers would be kind of is the first thing that comes to mind, right? Is there a business case for this? Is a major shift for banks? There would be a significant investment required to migrate to a different model. And, would that be a quick cutover? Would it be something that you'd have to do in parallel? The cost there would need to be offset by some benefit, maybe a reduction in the amount of reports or individual filings that you have to submit. So that was the first kind of thing. And when you start to think about that push model, we kind of do some of that today as an industry, right? There are certain production processes, the intraday liquidity reporting comes to mind, and CCAR in the US, some of that detailed granular reporting that's sent to the regulator for them to do their own calculations is kind of in that push mindset, right? So I kind of was looking for that all the above, because I do think there could be a situation where we stay in a push model for certain types of data that has maybe monetary policy requirements, but more active, risk management might need to be done in a way that the regulators have access to data in a more timely manner, right? And that kind of does speak to the role of the regulator as well, right? Are they going to be an active manager or a passive reviewer, right? And so, it's a complicated topic, and I really do appreciate the opportunity to talk about it, because I think there are numerous considerations that I'm sure we'll talk about here coming up that make it a very, what seems to be a very simple question, a very, very complicated one.
Indeed, it's a very simple question that it's like an endless abyss of complexity. And you touched on this point about granular data. So maybe I'll ask you, Carl. Can we talk about a pull system without talking about granular data? Is there any point switching this sort of communication mechanism if we don't change what we are actually transmitting?
I think some of the benefits that you get out of like effectively a pull model is that you have more access and availability to granular information to be able to analyze that. Think about a Rubik cube, twist it in the different directions to get the answers that you actually want, which I think is one of the big pluses of a pull model. We need to fundamentally rethink the way that we're dealing with that, because today, like if I take in the US, for example, I have a standard capital report or a standard balance sheet, income statement. They're all aggregated, and that information that takes a lot of infrastructure, people, process, interpretation. There's a lot of kind of thought process and I'll call it technology that goes into that. If you just provide a pull environment that is going to allow somebody to pull like my total loans outstanding or my total credit balances, etc., that doesn't add any benefit. I mean, it eliminates what we would term as like a last mile reporting, where I'm literally taking a consolidated report, sending it out, I'm just going to store that somewhere. I don't think that really gets to any benefits for either side. I think you still got to have the full internal processes within a firm to aggregate, consolidate, control, build, all from the base data. And the regulators have no additional access to information to be able to, back to my Rubik cube, to twist it a different way because they want to look at a certain scenario. They want to look at the underlying data. So it has to be a fundamental shift. And I think that's to what Jody was saying. There's a significant overhead cost to doing that, but there is benefits to doing it, both on the side of the regulators and on the side of our firms as well. But I think we have to think very differently about how we look at the data we're providing and be much more conscious of the granularity of that data. And then that leads to a whole lot of other, I'll call it technology challenges in terms of, I think about like any large multinational firm, we're talking about millions and millions and millions of trades. And all of a sudden, like having that capability to store them in a way that's easily, you can API into that. Like then we think about the controls that we have to have around that, the frequency in which those controls are done, because I think data quality is a super important aspect. At the moment, any large organization would know and understand like material data quality issues and probably has overlays, processes built within their sort of reporting processes to address those material challenges. If it simply is very granular transactional positional level data, that introduces another sort of dimension that an external party harvesting or pulling may not know about those data quality issues, may not know how the overlays should work.
Yeah, Carl, I think that control point is one that really kind of resonates with me. I know the challenges that I see kind of in some of these big banks, I haven't been in a few, is that the underlying data and getting it into a format that either would be available for a pull or to get it in the right schedules for a push. The amount of effort that goes into that is substantial, right? And the controls required to make that happen are pretty substantial effort to get those in place. I think even if it was a pure pull model, right, you still would have to go through the control process and make it, get it to a point where it could be then pulled. That I think it's kind of the same internal processing, right? Whether you're pulling transaction details together to figure out how to fill out a tick suite of reports versus to make it available for the Treasury to pull, the effort internally is largely the same, right? And so I think understanding how do you have it all, making sure that you have the right attribution, making sure you have the right derivations and enrichment, to me is kind of a wash, right? But what's interesting is if you were to make it available, right, in order for the consumers, in this case the regulatory agencies, to pull that data and use it, there might need to be some standardization in in attribution, right? And what comes to mind obviously is like counterparty, right? How would you consistently identify counterparties across the industry so that the Fed could easily consume them and cut and slice and pivot with that Rubik's Cube? You know, we've tried as an industry to get to a common LEI and have struggled, right? So, you know, and then if you start looking about doing that type of standardization across multiple types of reference data classes, and you know, how do you describe a product, right? I'm sure we all think we do it best, right? But you know, it should be relatively straightforward, but it's not, right? So yeah, that for me is that control landscape is a really you know, an interesting one to start to dive into, and how and would it even change, you know, in a push versus pull model.
Yeah, and if I can just piggyback on one of those things, sorry, Murat, if I can just piggyback on one of the things Jody said was around like that interpretation and the data attributes, even in CCAR where millions of loan level records with hundreds of columns of attribution, etc. There's still interpretation on like, you know, what's the loan amount? Like, is it the loan amount at origination? Is it the loan amount at last payment? Is it the loan amount to the reporting date? Like, you need really crisp instructions, and they need to be implemented systemically across jurisdictions around the world to make it really, I'll call it operationally easy for an organization. And then to your control point, like, we close books and records on a monthly basis. We don't close them every day. Yeah. So that anchor point, that reconciliation is super important for us.
Yeah. And in the one of the other pillars of the Bank of England project is a granular common set of data inputs, right, Andrew? And so I guess these two are, you know, inextricably linked together. And so how do you think about defining those and making sure there is an industry standard? As Jody mentioned, the LEI process, you know, was this sort of standardization dream we all wanted to get to. It got pretty far, but you know, that last mile is always challenging, and that's always maybe the critical bit to sort of get that uniformity.
Yeah, 100%. And I'm going to be quite boring, I'm afraid, and just say that I agree with everything that Carl and Jody has just said, actually. So I think both on the control points and on the data standards, yeah, these are very key issues that TDC is certainly looking at and is certainly wrestling with. I think just a couple of things to say to answer that question. Before I do, just to emphasize, you mentioned at the beginning, Murat, that these the views expressed aren't representative of our institutions. I should also say here, although I'm the chair of the Reporting Transformation Committee, these views aren't necessarily representative of the TDC either. So just to be clear about that before I then dive in, yeah, 100%. The data standards is a key thing that we are wrestling with right now. Data standards exist at the data item level. So as Carl's already given examples of, it's also about consistent formats, consistent categorization, so you're not having excessive effort spent on transformation. And it's also about defining that key data layer as well, which is that aggregate of for a particular product type. What are the, say, you know, 1-200 characteristics that comprehensively define that position, and that means that you can fully model, for example, or its risk points, its accounting, its cash flows, its conduct, whatever you're interested in as a regulator. So there's a lot of work to do to look at data standards. We have been looking at, well, what can we do about this? And obviously the ECB has got the Bird project as well, which is standardizing things. To some extent, I think the most useful thing that we can do at the moment is not so much about inventing new standards. You know, there are plenty of standards out there at the moment which are already in use, operational, they work, they're maintained, etc., etc. But actually, one of the key things is actually about making sure that in the regulatory reporting we're applying all those standards. So where we're asking for date, we're asking for it in the ISEF format. Where we're asking for a legal entity, where we're using, whether that's LEI or whatever other standard you're adopting, you're doing a consistent thing across that. So I think that at the moment is probably the most meaningful contribution that we can make in terms of data collection. Just gradually moving towards adopting more and more of these standards as best practice into the regulatory reporting.
I think, yeah, consistency, like you mentioned, is kind of the most important point. Often it doesn't matter if you call something an apple and orange, as long as everyone calls it an apple. And so I think that's a key thing to not lose sight of. And you mentioned, Jody, about timeliness, right? And so some of the benefits would be to have more timely data, or in different scenarios. Is there an optimal time? Is there a time? I think Carl was saying that you close books once a month.
Yeah.
What is a good, and what are the trade-offs of getting, if you get data faster and faster and sooner, there's trade-offs in quality. And so how do you think about that? What is a good, maybe using internal management, how do you, what is the good, ratio of speed to accuracy, I guess, for your data?
Well, I think there's a couple considerations there. One is the type of business or type of transactions that you're looking at, kind of creating more transparency to, right? So, there was a kind of a regulatory driver behind the need to provide intraday liquidity, right? Understanding liquidity of financial institutions is very different than understanding maybe your loan portfolio intraday, right? More static. It doesn't necessarily turn over with the frequency of a funding transaction, right? So there's that first consideration of the type of business and how static or how liquid it is. The second is, regardless of push or pull, you need to understand if you have the internal view, if it is comprehensive. And Carl makes a good point. If you look at a month end versus quarter end, control processing, oftentimes even between quarterly and monthly, there are big
differences,
right? Due to the additional regulatory disclosures that happen on a quarter end. So if you start to get to more frequent disclosure, let's say daily, right? What is the anchor point? I know a lot of financial institutions don't create a full-blown daily balance sheet or a full-blown income statement every day, right? So what would you be pointing to as the anchor point to ensure that you have it all, right? And that's not always an easy, an easy discussion as well. You could point to trader mandates as a way to say, this is the book of business, I'm doing P&L on this, and then that becomes the population that you could send or make available. But you need to perform additional control around that. There are cancel corrects, there are late adjustments, there are accounting adjustments, there are intercompany eliminations. All those would need to be taken into consideration, and the processes to perform those, you would need to understand the effort to align them to the distribution timing. And that's not, it's not always an easy change for some of those processes that do require maybe more complex calculations and reporting. Yeah.
Definitely. And so let's assume, sort of hypothetically, that we move to this pull model where granular data was available, and the supervisors would come in, take the data, make their own reports. Carl, what new kinds of challenges would that pose? I think you touched briefly on data ownership, but what do we need to think about if that is the sort of the future we're looking at? What other things do we need to think about?
Yeah, I'd just like to add on to one thing that Jody was saying around timeliness. And there is always a trade-off between how quickly I can get the information and how materially accurate it is. And one of the things I'd applaud the regulators in the US anyway, when we went through COVID, there was situational demand, and we went from effectively a quarterly reporting cycle to a weekly reporting cycle. But the demand from the regulators was, best efforts basis. And if you have something that needs to be revised, then let's just talk about it, not a hard and fast rule. So I think being open to that dialogue and discussion, which they were during that during the pandemic, or the early days of the pandemic, super important. In terms of if the supervisors are pulling data and some of the sort of challenges to that, I think Jody may have alluded to it earlier, is it really is eliminating that last mile, the last piece. We're not going to, I think about the analogy of, if I own a car and I know that the speed limit in the US is 65 on the highway, and I don't have a speedo, I'm relying on the police officer to pull me over and tell me whether I was going over or under. We're not going to have any large organization, or any institution really, is not going to just blindly be, oh, well, I'm just going to keep managing my business and just hope somebody else tells me my CET1 ratio is above the regulatory minimum. We're still going to run all of those internal processes. So I think it gives a big benefit to regulators to be able to pull that information. It gives a benefit to organizations to eliminate that last mile sort of reporting, aggregation, combination into a predefined report form. it doesn't eliminate the need for an organization to collate that data in a way that they know the regulators or the regulations require us to be managed as a firm. So I think that's one sort of major sort of impediment to the pool model. I think it does save, but it probably doesn't save as much as you maybe think if you just look straight on the tin and go, hey, you don't have to do any reg reporting anymore. I think one of the other things to touch on would be around data privacy, data security. You think about like GDPR, like we have very rigid rules around who can see what data. And like I work in the US for a US firm, you know, we have US regulators, but they may want information for, you know, European clients or Asian clients where there is a lot of secrecy requirements and laws. That oftentimes is an area where we have to spend a lot of time debating, discussing with the regulators. That wouldn't change in a pool model and actually becomes potentially more problematic because how am I masking data? Am I masking it this way for the Bank of England who are going to pull information, but I have to mask it a different way for the US regulators, for the Federal Reserve, for example. So I think data masking, data privacy, and then potential for data leaks is also an area of concern that you need to think about. Is who's going to end up on the front page of the newspaper? It's not going to be, you know, US regulator pulled data and then somebody got in the back end of their system. It's going to be, you know, firm X exposed all the customer data to the world. So I think data privacy, data access are big concerns. And then that internal, we're not going to fly blind. We're not going to just rely on somebody else to be telling us what's happening.
And so I guess maybe a question for you, Andrew, is if a firm still wants to, you know, measure all their ratios and calculate all their metrics according to the regulations to maintain compliance, and that's probably the, I guess, the intention of regulation as well, is to self-manage better. Then where, I guess, is the cost savings and where are the efficiency gains coming from? Or is it, it's not a cost saving, but it's more the benefits that we're considering the pool model?
Exactly, but I think this comes back to the point about the silos that we have at the moment, because I think a lot of the time you have regulatory reporting and you have MI in separate silos. So even something like CET1 ratio, you might be surprised that the regulatory reporting of CET1 ratio in many firms actually sits in different systems, different teams, different processes, but versus your CET1 internal management. Because of course, when you're internally managing it, you're not just interested in what it was 15 days ago. You want to know actually what is it now? What is it going to be going forward? You know, so there's all sorts of different ways that you want to measure it. So I think where the benefit in terms of the cost saving is purely in what Carl was mentioning in terms of that last leg of getting your data and transforming it and then aggregating it and then going through that process to make it in a specific way that the regulator specifically asks for, which firms actually a lot of the time don't find particularly useful or relevant to how they manage those fundamental ratios. So I think that's where the cost saving comes on the firm side. In terms of the general point about that Carl was making about, well, firms are still going to have to manage it themselves. 100%, yes. I think everybody really appreciates that. And what a pool model introduces, and actually not just a pool model, a granular model. When you're submitting granular data to the regulator, which they're then doing an analysis on, it introduces a risk that the regulator, they will go away, they will do their analysis, they will come back to the firm and they will say, we've noticed X, Y, Z from your data. And the firm could then say, yes, 100%, we're seeing it too, and this is why, and this is what we're doing about it. But equally, they could turn around and say, well, actually, that's not something we recognise, and that could be because the regulator has misinterpreted the data. That could be because the regulator is not familiar with the particularities of that particular product and how that particular product works in practice. So you're reporting it in a particular way that actually doesn't actually work that way. So it could be because of that, or it could, of course, be because the regulator's got some insight, perhaps, of course, because they've done peer analysis and they're looking at data from other institutions, and they've got some peer insight that's valuable to the institution, but the institution hasn't actually got itself. So I think what it all adds up to is I think we need to move to, as Carl was saying, in terms of the post-COVID situation, where it's a lot more of a collaborative effort between the regulators and the industry when we're looking at regulatory reporting. So it's not a sort of gotcha, you've done something wrong, we're getting the stick out and hitting you with a kind of attitude. It's much more that collaboration, working together to reduce risk across the system, which obviously is an example of the TDC, the industry and the regulator working together, and hopefully that can infuse into the system across regulatory reporting as a whole.
Jody, do you think that if we move more away from the system of sort of do your homework and teacher checks the answer to more of we do the work together in this collaborative approach, we're both huddled around the same granular data, trying to see how we got to some result or what the trend is, that it'll change sort of this culture and the dialogue, maybe even between firms to be more collaborative, or firm and regulator, as opposed to everyone sort of working on their own and getting feedback on their own?
Yeah, it's an interesting question, right? I think there is a there is a definite, clear, undeniable kind of value that the regulatory bodies bring in terms of systemic risk, right? And that's not something that you're going to replace by having an institution kind of just work with its peers. So there is a need for institutions to kind of provide data in a way that can be, combined for that purpose, right? But it is interesting around the concept of internal risk management and how where does the responsibility lie, right? I don't think you would ever get to a situation where regulatory bodies would calculate RWA, right? Or capital charges, although they do calculate CCAR and compare it to our internal view. But that is a bit of an interesting kind of approach, right? Where there is that feedback and dialogue with the regulator to say, hey, listen, we calculate your capital charge to be this based on the data you provided, and you're reporting this, and that to me was a healthy dialogue during the early stages of CCAR, right? Where there were differences in terms of methodology, treatment, and that was useful for institutions maybe to mature in how they manage that capital risk, right? So that could be very helpful, right? So more granular data received by the regulators provides the opportunity for them to create views of risk, maybe independently from the institution themselves, that could facilitate that healthy dialogue. And we did see CCAR, being an opportunity to do that. The bulk of the regular reporting today, though, is really not that, right? It's statistical, it's statutory, it's information that's compiled for, let's say, monetary policy, or trying to get across a systemic view. It's not really aimed at refining risk management or identifying emerging risks, right? I would argue that's not necessarily like that today. And in a push model, if you did provide transparency to more granular data, I think there could be some of that would be open to the regulators to start to think through and identify some of those risks that may not be specific to a loan institution. Yeah.
And is there an opportunity, would you say, to make some of this information more public? Like, not obviously granular details, but for trend analysis, this high level, a bit like the Pillar 3 disclosures that are made public, maybe a bit more granular than that, for all the sort of machine learning and economists and all the other minds out there to highlight things, or a bit like financial statements. You have people do financial analysis after the quarterly reports and so on. Do you think there's scope for that, or would there be interest? And anyone, Carl, do you?
I can jump onto that one. I think
open sourcing some stuff.
I was gonna say, I think interest, probably yes. Desire from organizations depends on the level of granularity. So if you look at FRTB rules and proposed changes to the Pillar 3, it was getting very granular down to almost like desk level type positions and holdings. That's proprietary information that would potentially allow somebody to infer how desks are positioned and maybe put you at a competitive disadvantage. So I think what we find very useful would be aggregated data that tells us about like the overall industry, so we can then think about like how are we as part of that component of the industry, so we know like where we are a significant player versus less of a significant player from a not just from a sort of business perspective, but also from like, you know, where should we be focusing our efforts on making sure our data is of the highest possible quality? Because if we're a significant player, then we should make sure that our information's as good as it possibly can be. If we're a very tiny player, then some of those additional asks and surveys and things, it's not really a material impact if we as a firm or a particular institution was to not participate in those. So I do think there's definitely opportunity to get some more insight, but I think it has to be a balancing act, and we definitely have conversations with regulators around, you know, what level of information is published publicly, and then how is that actually interpreted? So like if you think about like country exposures, we have disclosures in our 10Q and 10K, we have a 009A in the US, which is a country level breakdown of your countries that go over a certain threshold. Both of those two things use different methodologies. How many people actually know that they use different methodologies? And it's not going to compare, oh, country A, why are they different numbers? I think that leads to that interpretation risk. And I think is the data fit for the purpose you're trying to use it for? I think that is something the more granular information you get, the more transparent it has to be about exactly what is that data. And I'll use, you know, plain English terms. Don't talk in like Basel capital speak, because people may not be able to understand that.
Yeah,
so,
sure.
And I think that interpretation risk is very, very real, and also very very hard to iron out, because even when we do implementation with firms, they'll often send you data, and you get data and immediately start interpreting it, whether you realize it or not. Subconsciously you try to associate it with something you've seen before, but it's never exactly right. And so you do need that dialogue, that education. And I guess maybe a question for you, Andrew, is the pool model and all this granular data would be a huge burden of work for I guess supervisors to get up to speed and understand how different firms work, different product types, different subtleties, and how those products are traded, or the jurisdictions, and so on and so forth. So what are some ways that can be mitigated or enhanced? And we spoke about the data definitions. Are there other things that you guys are thinking about in your program?
Yeah, I think that's a really key question, because some of these opportunities are to do with data science capabilities, not so much on the firm side, but on the regulator side. And there are a number of key requirements on the regulatory side. The first is they need to have the systems to be able to cope with the level with the data, and to be able to do the analysis and aggregation, and to make it meaningful. That requires a lot of investment. Certainly in the UK, both the FCA and the Bank of England are putting a lot of investment in there. That they see that as really important in terms of fulfilling their mission, their mandates. But that's certainly a prerequisite. But you also need the staff. You need somebody to actually pick up that data, analyze it, and do something with it, in terms of going out to the firms. And that's a particular challenge. If you're approaching this from the context of you might have a regulatory team with I don't know, let's say half a dozen people in there supervising a single GSIB bank. Clearly, that's a very different scenario to if you're sat, for example, at the FCA, where you might have a team of maybe 2 or 3 regulators who supervisors who might have 1,000 or upward of 1,000 firms that they're regulating. If you think about sort of individual IFAs, individual financial advisors. So that's a very different model. Clearly, when you're dealing with that volume of organization, it can only ever work if you're talking about data in a standard format. And that's the area where any kind of pull mechanism, I think, is less likely to be valuable, to be successful. But it's still an area where we're having standardized data, we're having granular data. All of those kinds of things are still very much important, and still very much valuable, and in some ways more valuable, because of course, if you've got standardized definitions across all of these smaller firms, you can do your analysis across that large number of firms. You can identify those outliers. You can then take your supervisory actions in relation to those in a way where you possibly can't if you're just relying on aggregate reports that aren't giving you actually quite enough information to be able to look into it.
So, Murat, can I just add something to that? It was like, I think the amount of data we're talking about, if we're getting to sort of granular trade level or position level information, easily maintainable, like in a cloud type environment. And then there's analytical tools that are cloud native, that, you know, almost off the shelf, you can pull them in, you can start running anomaly detection, things like that. I think part of the challenge is going to be, and this is not just for regulators, I think it's just us as an industry, is that changes the dynamic of who you're hiring. Like, you're hiring people who are more data scientists, more people who are technology type backgrounds, etc. Where traditionally both regulators and firms in this sort of space are typically hiring SMEs on like regulatory reporting requirements, you know, BCBS, you know, 239 requirements around data. Like, we're hiring people who have that subject matter expert, and it's a bit of it's a quantum shift. And you know, most organizations are going through that because they realize the value and power of data, but it does change the dynamic of who you're potentially hiring. And then you also are competing with like the Googles and Amazons of the world who offer types of roles around data science. So I think it becomes a demand challenge as well, but I think there's definitely opportunities to invest in different talent and then new technologies on both sides, regulators and firms, to be much better at the regulation and supervision.
I think that's absolutely right, but I think there's a nuance here which we need to work through, and I think we haven't really got right, I have to say, as an industry, and that's that consistent understanding about what does good look like in terms of controls, particularly for aggregate level, for atomic level data. And I have had, you know, I've been bitten by this myself in the past, where you have processes which are based on, particularly if they're based on STP, and it's very much based on data scientists and technology people and IT people who are running controls. You end up with controls which are based on change and system change and things like that, and obviously that's important. But you then end up with things that are based on processes and have processes being run and things like that. And I think that leaves quite a big gap, because you do need the people who understand what the risk means, what you know, what does it mean in terms of liquidity risk or interest rate risk or market risk or whatever that is, and that side of the review, when it comes to reviewing atomic level data, transaction level data, real-time data, I think is often missing, and I think we haven't quite got to a consensus yet in the industry about what good looks like, and I think that's a key piece of work that we need to do.
If, you know, looking at granular data, I think Jody, you touched on this control topic. You know, so when you submit reports, someone can actually look at those reports, compare them to the previous month or quarter, you know, a few thousand numbers, let's say. But how do you control billions of rows of data? And it completely changes that, I guess, that governance framework as well, because you can't do it line by line. So what could that look like?
Yeah.
What do you think?
Well, I mean, I think we touched on kind of briefly the technology kind of step improvement in terms of capability with large data volumes, right? I think that is kind of a driving foundational factor that gives us the ability to even have this discussion, right? 10 years ago or 20 years ago, right? You know, big data lakes and big data platforms to do, but like there wasn't even really in the conversation in a meaningful way. Now it's ubiquitous, right? Everybody has that type of capability. So large data volumes, I think, become less of a concern, right? So then you start to get to, well, how do you manage quality over such a large data set, right? And we're all struggling with that as well. Obviously, you start to take a look at tools that facilitate kind of the understanding of that quality in a way that is more machine-based. So, machine learning and AI factor into, would need to factor into assessing and evaluating quality. But to Andrew's point, they can't be defined by what I would call rudimentary rules about data formats, right? It would have to be for this specific type of financial instrument, right? And how it has been used in this specific business situation, what would be the required attributes, right? That type of learning is a lot more complicated to code up, but is really required to understand the true quality of that data set. So I think machine learning and AML and AI would, they'll come up the curve very quickly to facilitate that type of data set. But But getting back to, I think the root of, what would be the anchor points? How do you know that you have it all? How do you know that the data is timely? How do you know it's complete? How do you know it's accurate? Borrowing my BCBS language, right? There would need to be a lot put in place, over those data sets, that are in flight today, that I think would persist in a push-pull model, right? So, I think understanding what those controls are and how they'd be implemented in a large data, I know all the banks are thinking about doing that and are making progress in that space, right? So.
And here's a question from the audience about APIs. I'll ask you, Andrew. In terms of, if there's a lot of this sort of API-driven pulling, regulators logging into banks, this becomes a much more sort of, I guess, IT system, which then it could be subject to sort of IT attacks and denial of service and, other cybersecurity threats. And so what do you think about, I guess, how that would look like, and are the supervisors set up to actually, that's not a skill set, as Carl was saying, that they have currently. It's not processes they run. So will that not be a risk of having a pull model, I guess?
Yeah, completely. And I think Carl's already touched on the issues in terms of personal data and anonymizing that data, but both from the point of view of cross-jurisdictional, but also in the sense of protecting against attacks, so that if it is worst case revealed, then you're not putting that personal data out there. So that's one element. I have to say there's other elements as well. Commercially sensitive data. If you're dumping a full loan book of a full granular analysis of your entire loan book, obviously that's going to be commercially sensitive. There's going to be all sorts of stuff in there that's going to be of interest to competitors. How do you manage that risk? Well, that's really hard, and certainly you need all of the usual IT security, both on the firm side and also, of course, on the regulatory side. That's definitely something that needs focus on. In terms of the other risk is and I think we need to be a little bit careful when we're talking about a pull model. When because of the need for that data to be standardized, I don't see any move certainly in the short term to the regulator accessing core systems. I don't see any need for them to either. What I would see it would be more likely is that it will be some kind of for want of a better word, a regulatory data warehouse, where the data gets dumped into that core system, and then that's the area where the regulator would access. And what that would also do is that would also address another key risk, which is the risk of data change. Because of course, if somebody hacks into that system and then changes that data, if it's only in quotes used for regulatory reporting, that's less of an issue than if they're actually hacking into that core system and it's affecting customers' data, customers' accounts, etc., etc. So I think having that extra layer of separation, I think would also provide a degree of assistance against that.
That's very interesting, and I guess we can't avoid the topic of AI and machine learning. And using these new technologies, big data, they all go together. And as Jody was saying, it's been growing the past decade or so. It's sort of exponential growth and I guess the development of these newer technologies. But the cons of these newer technologies that they lack precision. And so they're good for things that maybe matter less, where you're showing one or two, choosing between what advertisement you're going to show someone. But then they come under a lot of scrutiny and, I guess, criticism in sort of critical situations in healthcare and defense and so on, where the legal system where you can't make a wrong decision. So I guess the question I want to ask you, Carl, and let everyone else chime in as well, is regulatory data like health data and the legal system? How precise and how accurate does it need to be, or are the trends more important? Or again, does it matter? Does it depend?
I think if you depend on the outcome, if you think of healthcare data, that's oftentimes a matter of life and death. So do we make a bad decision that can have a fairly catastrophic impact? same thing could be said like about like if you make a bad decision about loans and things like that, and you make a bad decision that may impact an individual person's quality of life. You may have knock-on impact. You really don't know. I mean, you know the first order impact, but you don't know what the second, third, fourth order impact, etc. are. So I do think there is benefit to using advanced technologies. I do think you have to I think back to what Andrew was saying, like you have to have a smart person who's training that machine. Like you can't just let it go and do what it wants, because it'll run an algorithm, it'll throw out an issue, and most organizations will face this. You'll get lots of false positives. Why did my lending go up in this jurisdiction? Well, that makes no sense. Historically, it's never done. You have to be able to layer in the contextual to take data and make it information. And that context might be, oh, the jurisdiction, that local government just offered like a tax break for people if they have personal loans. Okay, all of a sudden, no surprise, we've got more personal loans coming in that environment. So I think it's really important to use the technology, but then also have the subject matter experts looking at that, training the technology so it can learn and can be more precise. And then you have to feed it with more and more contextual information. And we look at that in terms of like, consumer information, job levels, house pricing indexes. You think about all that, there is a huge plethora of macroeconomic variables available. Part of the trick is how do you get the machine to start bringing those in so you just don't make a black and white decision. So that's expensive, hard, time consuming, but it may end up like if you have regulators pulling information ad hoc and doing what they want and need, they may end up with the wrong conclusion, and without a dialogue and a discussion with the firm to say, oh, this is the conclusion we came to, this is how we got there. And the firm goes, okay, well, yes, we launched a new product. It maybe doesn't fit your data model that well. So being able to have that interaction and dialogue, it can't be operating in silos.
But Murat, just to give an example that I heard recently about how such data could be really helpful. This is an example from the US actually, looking at default rates across small banks for agricultural loans, and they were able to combine loan level data on loans with climate data, and they could see some clear parallels where unsurprisingly, if you look down at that local area and you see certain weather patterns, then that actually has a knock-on effect and actually ends up impacting on default rates. And that's the kind of thing which actually suddenly you've got information which is actually really useful and actionable, because then the supervisor can then say, right, okay, as soon as this weather event happens, we'll get in there, we'll identify what are the banks that are going to be affected, and we'll go straight in and we'll take some supervisory action to make sure that we're managing that situation. That's only possible if you have that aggregate level of data, and you're able to combine it with other information, and you're able to use things like AI to machine learning to identify those trends.
Yeah, absolutely. What do you think, Jody? What kind of benefits or risks do you see?
Obviously, when you start to bleed into the AIML space, right? Could spend a whole another session on that alone, right? You have governance, you have model bias, you have bias in the underlying data. There's a whole bunch of considerations that I think would need to be taken into place. I think to kind of steer us back towards kind of push versus pull, right? Obviously, all those kind of factors, big data and machine learning and AI, they facilitate the ability to kind of to head in this direction. I still think it's interesting to think about what the drivers would be in order for this change to happen, right? In my mind, there's usually three things that drive change, right? One is it's mandated somehow, right? So the regulators could say, we want the data in this format, in this database, in this warehouse, right? And that could be a driver for this. The second could be truly an efficiency play, right? There is a benefit for us as an industry migrating towards a shared kind of warehouse that we all load, as long as it would facilitate eliminating regulatory kind of demands in other areas, right? If it's truly an incremental ask, I don't think you'd see us landing there, right? I just don't think there's appetite to support the benefit of the industry, given we're all, subject to our stakeholders. And the third area is control improvements. And as we discussed earlier, I don't think that the push versus pull model really materially impacts the control landscape, right? I still think you need to control the data in the same way to get it available for distribution for pull or for push. So I don't think the control kind of enhancement aspect really comes into play here. It would really need to either be regulatory mandated or truly an efficiency play, which, you know, we discussed some of the complexities and challenges around, you know, the potential incremental costs associated with migrating and changing that approach, which would need to be offset by regulatory changes. Yeah, so.
I'm conscious of time, but can I just come in on that efficiency point? Because I think this is really important. If all you're doing is coming in and saying, here's an extra layer of regulatory reporting that's required, you're not going to make any progress in terms of efficiency. But I think there is a solution here, because there are a number of existing transaction level or atomic level reports that are in existence at the moment. So, for example, you've got them for derivatives under the G20 mandates. You've got them for mortgages in the UK under the Bank of England transparency templates. And I think if we see it as more of an evolution in the sense of taking those, expanding them so that they become fit for purpose, they become these universal comprehensive templates for which cater for all, and then use that to then say, right, now we've got that, we can strike through this and strike through this and strike through this. I think that becomes a way forward. But I think what it can't be is it can't be just yet another report on top of all the other reports that we're doing.
How do you?
They've been great closing comments. I didn't ask for it, but Carl, one final closing comment, and we've run out of time.
No, I think this is a fascinating topic, and I think you could be on either side of the fence. I think we should keep the dialogue because it is potentially a good way to go in the future. I think right now there's a few hurdles that we need to, you know, jump over to get ourselves comfortable that the return on investment actually is there.
I think that's a great point, and I think the whole point of this and the white paper is to facilitate that dialogue and getting people to talk to each other and discuss all the different pros and cons. It's a very complex issue, I think is the best way forward. So thank you very much to our panelists and to everyone who attended. I guess to be a follow-up with a summary and the white paper itself, and so look forward to speaking to you all soon. Thank you.
Thanks, Murat. Thanks, everybody. Pleasure.
Thanks all. Cheers.